Up until now, we've covered the foundations of liquidity risk management, the structures, processes, models, and strategies that banks use to monitor, manage, and prepare for liquidity challenges. But the financial world is changing fast. New technologies are emerging, market infrastructure is evolving, and regulatory priorities are shifting to reflect a more digital, interconnected, and real-time environment. In this session, we'll turn our attention to the future. We'll explore how artificial intelligence, central bank digital currencies, and real-time payment systems are set to reshape liquidity management. We'll look at the opportunities these developments create, the risks they introduce, and how banks can prepare to adapt. By the end of this session, you'll have a forward-looking perspective on what's coming next in the world of liquidity risk. So let's start with artificial intelligence and machine learning. Now, AI is already beginning to transform areas like fraud detection, credit risk modeling, and customer analytics. But its impact on liquidity management is just beginning to be felt. One of the most immediate applications of AI in this space is in the liquidity forecasting and cash flow modeling space. Traditional forecasting methods rely on static assumptions and historical averages. AI, by contrast, can ingest vast amounts of data across transactions, customer behavior, market activity, and macroeconomic indicators and identify patterns that human analysts might miss. For example, AI tools can detect early signs of deposit volatility by analyzing behavioral signals, such as changes in login patterns, mobile app usage, or transaction types. Now, these insights can feed into the dynamic forecasting models, allowing Treasury to anticipate liquidity needs days or even weeks ahead of time with greater accuracy. Now, in the same way, AI can optimize the allocation of liquidity across business lines and legal entities by modeling usage patterns, funding costs, and asset liquidity under various conditions. Now, another area where AI adds value is scenario modeling. Instead of relying on a handful of predefined stress tests, AI can simulate thousands of potential paths using Monte Carlo methods or reinforcement learning techniques. Now, these simulations can highlight rare but plausible risk events, such as simultaneous shocks to funding, market liquidity, and collateral requirements. They can also uncover correlations between risk drivers that traditional models might treat as independent. Now, natural language processing, or NLP for short, another branch of AI, is also being used to monitor news feeds, market chatter, and social media for liquidity, which are all relevant signals. For example, if sentiment around a bank or a sector suddenly turns negative, AI can detect this in real time and trigger alerts for Treasury and Risk teams. Now, while not yet widely deployed, these technologies offer an additional layer of situational awareness, particularly in a world where market confidence can shift in seconds. Of course, the use of AI brings its own challenges. Models must be explainable, auditable, and aligned with regulatory expectations. Many regulators, especially in the UK and EU, are cautious about the use of black box algorithms in risk-sensitive areas. Banks must ensure that AI-driven forecasts or decisions are interpretable, tested, and subject to governance controls. This includes documentation, validation, and alignment with existing model risk frameworks. There is also the question of data privacy and ethical use, particularly when customer data is involved. Despite these challenges, the direction of travel is clear. AI will become increasingly embedded in liquidity risk infrastructure, particularly in forecasting, optimization, and early warning. The banks that invest early in responsible, well-governed AI will have a competitive edge, not just in managing risk, but in allocating capital more effectively and seizing opportunities with greater confidence. Now, let's turn our attention to central bank digital currencies, or CBDCs for short, arguably one of the most talked about developments in global finance. Now, CBDC is a digital form of central bank money, like cash, but issued and settled electronically, often in real time. Several jurisdictions are experimenting with CBDCs or considering launching them, including the Bank of England with its Digital Pound initiative and the European Central Bank with its digital euro exploration. CBDCs raise fundamental questions for liquidity risk management. One of the most immediate implications is around deposit stability. If customers, particularly retail and small businesses, gain access to a risk-free digital alternative to bank deposits, the potential for rapid outflows increases. Now, in a stress scenario, customers may move funds from commercial banks to CBDC wallets almost instantly, without queuing at branches or calling support. Now, this increases the risk of digital bank runs, especially if CBDCs are accessible 24/7 and perceived as safer than traditional deposits. Now, this changes the behavioural assumptions that underpin liquidity modelling. Banks will need to revisit their assumptions about deposit stickiness, customer reaction times, and stress outflow rates. Liquidity stress tests may need to incorporate new CBDC-related scenarios, such as a policy shift that increases CBDC limits, or a technology disruption that causes uncertainty in the banking system and prompts rapid flows into digital currency. At the same time, CBDCs would also enhance liquidity operations in certain ways. For example, central banks might allow CBDC accounts for financial institutions to facilitate real-time settlement of interbank flows or securities transactions. This could improve the speed and reliability of liquidity transfers, reduce counterparty risk, and enhance intraday liquidity management. However, this would require significant updates to banking infrastructure. Treasury systems would need to be compatible with CBDC platforms. Risk models would need to reflect new payment speeds and volumes. Funding strategies would need to adapt to changes in deposit composition and velocity. And governance frameworks would need to manage the interaction between commercial bank money and central bank digital money. Now, there are also regulatory implications. Supervisors are still defining their expectations around CBDCs, and banks must engage actively in policy discussions to shape the outcomes. In the UK and EU, regulators have already begun consulting on the prudential treatment of CBDC exposures, deposit insurance, and the role of banks as intermediaries in a digital currency ecosystem. These decisions will shape the liquidity landscape for years to come. Now, beyond AI and CBDCs, another transformative trend is the move towards real-time payments and settlement systems. In many markets, payment systems are shifting from batch-based end-of-day settlement to continuous, near-instant processing. The UK's new payments architecture and Europe's target instant payment settlement, or TIPS for short, are examples of this evolution. These systems promise faster, more efficient payments for customers, but they also compress liquidity cycles for banks. Traditionally, banks had time to manage their liquidity positions throughout the day. They could rely on predictable flows, end-of-day sweeps, and overnight planning. In a real-time environment, those buffers shrink. Payments can occur at any time, from any location, and in any volume. This creates new pressure on intraday liquidity, requiring more precision, visibility, and responsiveness from Treasury teams. To manage this, banks are investing in real-time liquidity monitoring tools that track cash positions across accounts, currencies, and systems. These tools provide dashboards and alerts to ensure that payment obligations are met without overdraft or delay. Some banks are even building liquidity bots, automated agents that monitor flows and execute funding actions automatically within preset risk parameters. The shift to real-time also affects contingency planning. In a traditional model, a liquidity crisis might unfold over days or hours. In a real-time world, it could unfold in minutes. This means that contingency funding plans must be faster, more streamlined, and more automated. It also means that early warning indicators must be sharper, able to detect stress signals quickly and accurately. There are also implications for funds transfer pricing. As payment volumes increase and funding cycles shorten, banks may need to rethink how they allocate liquidity costs across business lines. FTP systems must become more granular, responsive, and reflective of intraday activity, especially for high volume, low margin businesses like payments and transaction banking. Now, technology is also enabling new models of liquidity sourcing and distribution. Some firms are exploring blockchain-based liquidity pools, decentralized finance platforms, and tokenized assets that can be used as collateral or funding instruments. Now, while these remain largely experimental, they point towards a future where liquidity is more programmable, composable, and transparent, though not without new risks. One overarching theme in all of these developments is the growing convergence of liquidity and technology. Treasury teams are no longer just cash managers. They are data analysts, technologists, and strategists. The systems they use must be real-time, integrated, and predictive. The decisions they make must account for new behaviours, new assets, and new speed. And the controls they operate must be fast enough to keep pace with markets that never sleep. Now, to prepare for this future, banks must act on multiple fronts. They must invest in technology, upgrading systems, hiring talent, and embedding analytics into Treasury workflows. They must engage with regulators, participating in CBDC pilots, contributing to consultations, and reshaping prudential policy. They must review and adapt their risk frameworks, modifying stress tests, FTP structures, and contingency plans to reflect new dynamics. And they must foster a culture of agility and innovation, where Treasury is empowered to experiment, learn, and lead. To summarize, the future of liquidity management will be faster, smarter, and more digital. AI, CBDCs, and real-time payments are not just incremental changes. They represent a shift in how liquidity moves, how risk emerges, and how banks must respond. The banks that succeed will be those that see these trends not as threats, but as opportunities to build resilience, improve efficiency, and lead the industry forward. In our next session, we'll dive deeper into digital transformation, exploring the evolution of Treasury stacks, data architecture, and platform integration. We'll look at how Treasury functions are modernizing their systems and processes to operate at scale, with speed, control, and transparency. I'll see you in the next session.